Moving averages are a technical indicator, and they've been a staple of traders for decades. And there are many types of averages that use different formulas, but really the easiest one to use and understand is the simple moving average, which is the SMA. Now, a moving average is just a line that's on a chart, and it shows the average price of a certain number of days back. The simple moving average, which is the easiest one to calculate, is just the sum of the past X number of prices divided by the total number of prices in the series. So specifically, we calculate the SMA as follows, and we're going to use a 5-period average as an example, and the closing price of each day. So Monday, the price is 15. Tuesday, the price is 15.25. Wednesday is 16. Thursday is 15.60. And Friday is 15.65. So we use the formula, and that's just adding up all the prices and dividing that answer by the number of prices, which is 5. So here's what it would look like if you were to calculate the present day moving average for this example. The sum of all prices is 77.50. You divide that by 5, and the simple moving average would plot at $15.50 on the next open. So the plotted price of the average will change on a daily basis to match the current days or intraday bars. Now the SMA you apply to your chart, and it helps to smooth out the price action that has occurred over the period that you've chosen. So the moving average, it's a mathematical calculation of past price. So it is a lagging indicator, which means it's going to lag the present day price. Trend direction is the common use of an SMA, and there are several that are most commonly used by traders. The 10-day SMA is going to react to price movements quicker because of the shorter look back period of 10. And this may be of interest to shorter term swing traders or day traders. The 20 SMA is often used for shorter term overall trend direction. The 50 is an intermediate trend direction indicator, and 100 and 200 simple moving averages are longer term trend direction indicators. Now, if the average price of the SMA is increasing, we're going to see the line turned up, and that's going to indicate an uptrend. A decreasing SMA will generally point to a downtrending market. Now, how are you going to use this? Well, the SMA, it's a pretty versatile indicator, and I think it could form the part of virtually any trading strategy out there. It can act as a standalone indicator or be used to find the current trend direction and forecast the type of market that you're trading. It can also form a trading strategy of its own when you add in price action to your decision-making process. Here's how you find the trend direction. These charts have 4 moving averages applied to it, from a short-term average to a longer-term one. The one you would use to determine trend is going to depend on the type of trader that you are. So to determine trend direction, you're going to use the slope of the average as a determination, or trade the direction the price is in relation to the average. So if it's above the average, you're only looking for long trades. Now the white line is the 10-period SMA, and it's going to be the quickest in reaction to price. The slope and the price position here signal uptrend. The 20 is in orange, shows an uptrend. The green is the 50-period moving average, and while the price location shows uptrend, the slope of the average is down. The 200 is yellow, and in both cases, it's going to show a longer-term downtrend. You would then use this trend determination for your particular trading strategy. Now, using a technical analysis approach to trading is common, and many times price action plays a role in how a trader approaches the market. Now, one trading strategy that we can use with a single moving average combines the trend direction information alongside common price action trading patterns such as bull and bear flags. Now, markets trend, they range, they mean revert, and we can use the trend and mean reversion mechanics of the market to build an outline of a strategy that uses everyday price occurrences. So let's look at how to use a single average for trading. And in this case, we're going to use the 50-period simple moving average for a more intermediate trend direction. Now, there's nothing magical about a 50-period, and there's no best period to use. It's really going to depend on the time horizon for your trading. Now, this stock chart is a really good example because we have a few trend direction changes. At number 1, prices come off of a downtrend as price breaks the SMA to the upside. The slope of the average is sideways, and the price action shows a double bottom that is a higher low being put in. And with permission for long trades, especially with an upslope to the SMA, we look for standard pullback trades to the simple moving average. Now, this zone here has 2 trades, and the second one pulls back into the average plus the previous swing low. At number 3, price forms a trading range, but the lower shadows and the subsequent basing just below resistance points to more upside. And number 4, this corrective decline to the average is full of momentum. And that's one thing that we don't want to see when we're trading pullbacks. The same area has another pullback to the SMA and the previous swing low. Price begins to break down after this, but you should be able to see that the upside of using price action along with the average as a point of reference to take your trades. We are using a standard pullback pattern into the average price of the last 50 days. Price mean reverts back to the 50, and we can use a variety of trade entry techniques to get us into the trade. Now, another method that's used by traders is the belief that a moving average acts as support and resistance, and that is a myth. There's the appearance of support or resistance, but remember that we're looking at a mathematical formula to calculate an average. You can see a good example of the average acting as support in the last chart that I showed you at number 3. Here we have a chart of crude oil using the 20-period SMA for intraday trading. The dashed white lines are showing previous price action or structure extended to the right. And you're going to note that when price seems to find support around the 20, it's really coming into a place of previous price action. The highlighted area shows another way a moving average may appear to offer support or resistance. Price has begun to range, so the average price that's being calculated stays virtually the same. The slowing down of price action allows the moving average to catch up to current price. So the lesson, use the moving average, whatever period that you want, to show you zones of opportunity for trading signals, and then look left for previous price structures. Now, we've talked about using a single moving average for a trading strategy, but did you know that you can combine them? You can use a short-term average along with a long-term average, and that's a strategy that a lot of traders use. One of the popular ones is a golden cross of the 50 and 200 or the Alligator Indicator, but virtually any period can be useful. So for this, let's look at a 10-period SMA and the 30 period to give us a larger window to allow price to evolve. Because if we use too short of moving averages, we're going to get so many crossovers that they're really meaningless. So our strategy for the crossover will look something like this. The short-term average crossing the long-term average to the upside is bullish. When the short-term crosses over to the downside, we're bearish and only looking for a sell signal. So we want our pullbacks to at least close into the space between the two averages to give us a potential buy and sell signal. And you can use an average true range to place your stops and consider price targets or trailing stops to lock in your profits. Here we have a daily chart of the Euro futures, and the vertical lines highlight the trend changes. So to get into the trades, we're going to use a trend line break. And if price does not allow the drawing of one, we'll go to horizontal support or resistance levels. We want to allow the trend direction to confirm. So wait for the averages to cross, and then we're going to look for our pullbacks. At number 1, price action is sloppy, but when the small candlestick closes over the trend line, we could enter a long at market or set a buy stop order over the highs. At number 2, the trend has changed bearish and our conditions for a pullback are met. We can short at the low of the red candlestick that closed below the trend line. Number 3, pullback criteria met. We can short. At number 4, we can see strength in the correction, but our trend is intact and our entry trigger, the trend line break, is still in play. Number 5, the trend change, and this pullback fails into a trading range. So we can play a failure test of the lows and go long. And you can also set your entry order to the low or the high depending on the trend conditions of the candlestick or the bar that closed according to our plan. So in summary, we're going to trade in the direction of the trend, which is determined by the crossover. If the short-term average is on top of the long-term average, we're bullish. The opposite is for bearish. We need a candlestick close in between the two moving averages for trade consideration. This will be our buy or our sell signal. Our entry trigger is a break of a trend line or the break of the low or high of the candlestick that gave us our trading signal. The stop loss, we can use the average true range or around the swing low or swing highs with a buffer zone. Our profits can be taken via a moving average cross in the opposite direction at profit targets at maybe 2 or 3 times your risk, or just use trailing stops. But you have to ensure that you've written out your trading plan and you've covered all the bases, including risk management. Now, there are many moving average strategies that you can use, but please just keep in mind some really important things that we talked about. Remember, I said that averages, they're just a calculation of the past X number of periods. That's not a trading edge that you should really risk money on. So we added in price action using quantifiable market mechanics, pullbacks, mean reversion, momentum via breakouts of ranges into trends. And now it starts to make a little more sense as we're using something concrete. You will trade in the path of least resistance, which is the trend, until it ends. This way, unless you are entering when the trend is rolling over, it should allow you to manage your trade to lessen risk when the price moves in your direction. And as indicated by the charts I've shown, using an average as a suggestion of where you should look for trading setups or signals is a great start. Just look left to see if price is pulling it back into some sort of price structure. Having price pull back into the space between the two lines of the crossover strategy ensures that you're seeing an actual pullback in price. Advanced traders will read the strength of the corrective move as pullbacks that have momentum are a warning sign of potential failure. And this will add another level to your trading outcome as you're going to learn what pullbacks have a higher probability of advancing in your direction. So in the end, focus on what price is doing and where it is in relation to past price and the simple average that you choose.